Welcome to Talk Tickers. Today, we're digging into Herbalife's Q2 2025 earnings call. And wow, this one's a head-scratcher. You've got the company announcing this big, bold, new tech-focused era. They're raising their guidance, and what happens? The stock tanks. So yeah, let's get right into this paradox. And yeah, this is really the number that tells the whole story. A drop of almost 7% the very next day. I mean, this reaction just seems to completely fly in the face of what management was selling, right? They painted a picture of a really solid quarter with this super optimistic outlook. So what on earth did investors see that spooked them so badly?
Okay, so to really get to the bottom of that almost 7% drop, we've got to unpack the earnings results. Because when you first look at the numbers, they're confusing. It's a classic case of a beat here, a miss there, and a market that just seemed totally unsure of what to do.
And right here, you can see that split decision crystal clear. On the one hand, you've got a really solid beat on adjusted earnings per share. They came in 6 cents ahead of what Wall Street was expecting. But on the other hand, you've got the top line, the revenue, and it came in just a tiny bit short. You know, a beat on the bottom line with a miss on the top, that is just a classic recipe for making investors nervous. So if we dig just a little bit deeper, the picture gets even more interesting. I mean, operationally, the company actually looked pretty strong. Their adjusted EBITDA was almost $174 million, which beat their own guidance. And look at the cash they're generating, $96 million in operating cash flow. These are not the numbers you'd expect from a company in trouble. So what gives? Well, it seems the answer isn't really in the numbers themselves, but in the story that management was telling. You see, with that mixed top line, but solid operations, the company completely shifted the narrative. They wanted to talk about a huge strategic pivot. This wasn't just about Q2. For them, this was about defining the entire future of Herbalife. And you had the CEO, Stefan Graziani, framing this whole moment as, and I'm quoting here, a pivotal new era for the company. The message couldn't be clearer. Forget the Herbalife you thought you knew. We are turning into a tech-driven wellness platform. So the big question is, how are they going to pull this off? Well, their strategy really comes down to 3 main pillars. First up, new products. They're launching something called MultiBurn, a weight loss supplement, which, is a massive market. Second, and this is the real game changer here, they're rolling out powerful digital tools, and the headliner is a new AI-assisted app called Pro2col. And third, they're just keeping the house in order. Tight financial discipline, paying down debt, all that good stuff.
Okay, so let's be clear, the absolute centerpiece of this entire strategy is this Pro2col app. Management is pretty much betting the farm on this thing. The whole idea is to shift their business from just being transactional, just selling you a product, to being transformational. They want to use this app to build a much deeper, data-driven relationship between their distributors and their customers.
So you can probably guess what happened next. The analysts on the call just hammered them with questions about how this app is actually going to make money. And management's answer was basically, it's a multi-pronged approach. It's a tool to help sell existing products better, sure, but it's also a gateway to attract a whole new, more premium type of customer. And the most interesting piece, they're tying it to a new subscription model. But, and this is a big but, they admitted that the financial impact for this year is going to be pretty minimal. Okay, so let's recap. We've got this long-term tech story that isn't really going to pay off right away, and we've got that slight revenue miss. You think all that would lead to some pretty cautious guidance, right? Wrong. And that brings us to our next part, taking a look at their guidance, because this is where management's confidence was just on full display as they updated their outlook for the rest of the year. And you can see that bullishness right here in the numbers. I mean, look at this. They raised and tightened up their full-year guidance for both net sales and adjusted EBITDA. At the same time, they're cutting back on planned capital spending. Now, when you're an investor and you see that combination, it's a huge signal. It screams confidence in their operational control and their future profitability. And really, the headline here is just one word: growth. The company is officially projecting a return to top-line growth as soon as Q3. Now, after a period of declines, this is a huge, huge inflection point that the market has been waiting for. So it brings us back to that same question. Why the sell-off? All right, so this brings us to the next call, which is our take on the whole situation. How do we square the market's obvious skepticism with management's incredibly confident story? Well, it really just boils down to that classic battle: future potential versus today's reality. So for an investor, what's the play here?
To figure that out, we really have to look at both sides of the coin. We need to weigh the bull case against the bear case.
So here's how that whole bull versus bear debate really shakes out. The bulls, they're betting that this tech pivot, combined with the new products, is going to be the spark that reignites growth. The bears, on the other hand, are just laser-focused on one thing: execution risk. They're looking at the soft revenue now and are worried that this big, fancy tech rollout could just fizzle out, which would make all those operational gains totally irrelevant.
Okay, so taking all of that into account, our official rating here is market perform. Look, the strategic direction they're pointing towards is compelling, there's no doubt about it, but a great story is just a story until it actually shows up in the numbers. The market is basically saying prove it, and honestly, so are we. We really need to see sustained proof of revenue growth before we can get any more positive on this. And finally, that brings us to our trade idea for the next call. So let's try to translate all this analysis into an actual potential trade. Given this prove-it story we've just laid out, how could an investor actually play this?
So one potential play here is what's called a pairs trade. The idea is you would go long on Herbalife stock, but at the same time, you'd short the Consumer Staples ETF. That's ticker XLP. So what's the rationale? Well, this trade is all about trying to isolate Herbalife's company-specific turnaround story. You're basically betting that their tech pivot and all these growth initiatives will help them outperform the pretty slow and steady modest growth of the broader consumer staples sector. It's a bet on execution, pure and simple.
And that's our take on Herbalife's pretty pivotal quarter. You've got a company telling a really compelling story about its future, but you've got a market that's voting with its wallet based on the here and now. The big question is whether this tech pivot is a genuine transformation or is it just a new chapter in the same old book? The next few quarters are definitely going to tell us who's right. And as always, remember, this is not financial advice.